You're supposed to invest with money you won't need for the next 5 to 10 years. You don't plan on making a big purchase soon. I choose to invest in index funds and ETFs just because I know the Standard and Poor 500 or the stock market itself has been doing well over the years on average. So with this being said, this is 7 to 12% interest. So when I invest, I utilize the platform Robinhood just because it's no fee transaction, so I can buy and sell stocks without incurring fees. A lot of the brick and mortar institutions, the old school institutions like your Vanguard, your Fidelity, and your E-Trades, they charge you for each trade. However, I will say that those institutions offer a wide array of services, and they do offer promotions where maybe up to 500 trades you can get those free. So similar to Robinhood is M1 Finance. The difference is with M1 Finance they allow you to buy fractional shares rather than whole shares. I live by the mantra, scared money don't make money. I'd rather just buy the whole share, and compared to using a app like Acorns, which is beneficial and allows you to buy into different ETFs automatically with every transaction that you make on a daily basis. So that's good for someone who doesn't normally save. But for me, I'm an intentional saver. I don't consider myself risk averse at all. I'm a shooter, and shooters gonna shoot. Nonetheless, I want to share with you some of the ETFs that I invest in that work a lot like index funds. They're low cost and they've been doing pretty well over the years. So, that being said, I invest in the Vanguard ETF, and that symbol on the stock trading sign that you can use on any app is VOO, V as in Victor, and over the past 5 years it's gained 55% interest, and then just this year it's earned 7% interest. I also invest in the Standard & Poor 500 Value ETF, so that symbol is the SPY V, V as in Victor. It's earned 34% over the past 5 years and 7% this year. I also invest in the Standard & Poor 500 Dividend Increase ETF, which is the Noble N as in Navy, O, B as in boy, L. So 55% over the past 5 years, 12% earned interest this year. And lastly, I also invest in the Standard & Poor 500 Growth ETF. So that's the SPY G, G as in girl. And that has earned 73% over the past 5 years and has earned 8% just this year. So I'm also watching a lot of other ETFs. For one reason or another, I haven't invested in them specifically yet. Maybe because the price was too high, or maybe because, I fear that I might be overexposed to the soon to come recession that a lot of financial analysts talk about. So this is a list of the other ETFs that are doing well that I'm tracking. They're doing swimmingly over the past 5 years. You can just look at this list and see their symbols, and then you can do your own research on what they are and what those ETFs consist of. So I also watch ETFs that do well in a particular sector, and these are financials, utilities, as well as biotech. I'm also tracking ETFs that are overexposed to the market because they're weighted, so they may be doubly or triple exposed to the market itself. So when the market does well, they do extra well, and when the market does bad, they don't perform so well. But if you've been invested since the financial crisis in these, you're doing pretty well right now, because a lot of their increases over the past 5 years have been in triple digits. With all that being said, I do want to reiterate that past success in the stock market doesn't guarantee success in the future. So, do your own research and make your own estimations, but remember, this is money that you don't need. You're not supposed to need for 5 to 10 years. That way, if it goes down, you'll still have your money invested, and you're not trying to take it out which you would have to incur a loss if the market goes down. You want to just leave it in over time, and that way you're earning compound interest. With that being said, that's it. Thank you for tuning in to Buckley Carmichael. Let's keep this conversation going. Like, share, comment, start a conversation about money. Talk to your colleagues, talk to family members, see how people are, what different tricks, what types of lessons learned people are sharing, and get your money up.